Hi, welcome to MyWealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled, China is no longer an emerging economy. Alright, so as I woke Monday morning, I saw that the Asian markets, particularly the Shanghai Composite, it was selling off sharply. Alright, and I thought to myself, here we go. Alright, because my general feeling is that the U.S. equity markets have been a bit overbought as the valuations haven't quite caught up to price yet. Now, I wrote a blog about that last week, which you can check out if you like. Alright, yet the U.S. equity markets seem to shrug off this news and they actually finished Monday positive. Alright, so what gives? Well, it's no secret by now that China is funding U.S. debt through its purchase of U.S. treasuries with the surplus money it's gained from both the U.S. trade imbalance and China's peg to the U.S. dollar and other baskets of currencies. All right, as the dollar declines in value, so does the value of the Chinese yuan. All right, now this in turn makes China's goods cheaper to the rest of the world, which continues to perpetuate the cycle of this Chinese economic surplus. All right, now I have nothing against China making money, as I'm basically a capitalist at heart. All right, but now it's time to level the playing field. Now, what am I talking about? Well, let's have a look.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, China is no longer an emerging economy, but rather the richest nation in the world. All right. Well, actually, they're not the richest nation in the world. They're ranked third largest by GDP figures. Okay. But considering the massive debt that the U.S. is accruing at the alarming rate that we're going, I wouldn't be surprised to see them move up the list by year end. They're actually very close to Japan's GDP, so they could become the second very easily. Okay. But when we say they're the richest nation in the world, I'm referring more to the economic surplus that they have and the amount of cash that they have on hand. As a result of out of whack trade imbalances. As you know, there's very cheap labor in China, and when the U.S. imports goods from there because they can get it more cheaply, that sends money over to China, and that's how they get this surplus. So if China's got this huge economic surplus and they're the third largest country ranked by GDP, why do they still need to peg their currency? I understand the logic when they said, hey, we're a emerging economy and we're trying to grow and things of that nature. But hey, how much further can they grow? All right, it's time for them to get off of this currency peg, and start allowing their currency to float in the free markets. Because basically what's happening is that by having this economic or this currency peg, this is creating huge economic surpluses. All right, they've got all this cash on hand. So what do? Well, they buy U.S. treasuries, which is at paying very low interest. And what happens? Well, with low interest rates here in the U.S., all right, everybody starts buying things, and then you have bubbles. You have the housing bubble. You have commodity prices going through the roof. That leads to inflation. All right, now China's starting to experience a little bit of inflation of their own over there. All right, and they're starting to realize, hey, wait a second. If the U.S. dollar is so low right now and we're pegged to them, we're going to be just as low. And wait a second now, that's going to cause inflation here in China as well. So, we saw, when oil prices went sky high. You talk about the housing bubble here. So these economic surpluses, it's really gotten a little bit out of whack. And one of the major reasons, for that happening is China's peg to the U.S. dollar as well as other baskets of currencies. All right, so China should be forced to float its currency in the free market. Now, they're always saying, we can't do that. It's going to create, too strong a yuan, and now all of a sudden, they're not going to be able to grow at the rate they're doing, and they've got all these reasons why they can't do it, but at the end of the day they certainly can. Now there are projections out there by some economists that if they were to remove that peg, all right, they would appreciate by roughly 20 to 30% just right out of the gate. All right, now that's a pretty big move, and while that's dramatic, they could do it in stages if they agreed to play ball with the rest of the countries around the world, because at the end of the day, that would be a huge huge move, and that would create turmoil in the markets. But you know what? If they said, hey, we're going to do it over a 5-year period, and we're going to let it go, 30% or 40%, whatever, it could go, 5, 6, 7, 8% a year, and that would be a way to even the playing field, so to speak. All right, because now we've been trying to get them, to do this more and more, but they just say, no, we're not going to do it. And you know what? Everybody here and abroad, they're all afraid that we're not going to get any more money back from China. Ooh, they're not going to buy our bonds anymore, so we can't, finance our debt. Well, why don't we just say, hey, you know what? We're not going to pay you back if you don't float. We're only going to do it to the bonds that you own. We're not going to let them trade in the free market. Okay, anybody who buys bonds from you, those will not be honored. You know what? We're also not going to take your currency as well unless you float. So now they have a choice. Well, what do? Do they want to lose 8% a year, or do they want to lose the whole 100% of their investment in U.S. Treasuries, which by accounts is in the trillions of dollars? All right, that would be a way for the U.S. to clear its debt pretty quickly. So, that's something China's going to need to look at, and I feel like that's an area that the government needs to focus on going forward. All right, in the random chance event that something like this should happen. Now, I just want to make you aware that I'm being a little bit facetious with what I said previously about defaulting on their bonds or not paying them. We can't do that because of the credit rating the U.S. Government has with the treasuries. Okay, but there has to be some sort of way to get them to float its currency and allow the natural economic cycle to take over. But if they did float their currency, you want to take a look at ticker symbol CNY or ticker symbol CYB. All right, these are two Chinese yuan ETFs that, if they did float, it's obviously going to appreciate. So these ETFs would go up. All right, so don't wait. Get a course, get educated. Come to www.mywealth.com. Take a look at our currency investing and our ETF courses. It's really going to give you an idea of how the different political climates can affect your investments and how you can make some money in the process.
At the end of the day, China's policies have contributed to the global financial catastrophe, and it's time that they admit their role in it and make the changes necessary to fix it. Okay, because as was apparent on Monday, the U.S. markets no longer consider China a child, okay, but rather an adult economy with their own problems. All right, so maybe now it's time for China to grow up. All right, otherwise the other countries around the world just won't want to play in the sandbox anymore. So, to learn more about how economic policies can affect different currencies, be sure to check out our ETF and our currency trading courses. So, I'm Mike Conlon. Thank you for being with me, and I hope to see you in those courses.